control of this stock and it increased in value. I bought a call option at $100 a share, and the stock has increased 150. I don't have $150,000 to buy 1,000 shares of these things. What do I do? Well, you don't have to buy the stock. You just need to sell the option. And that's what the exchange is for. The exchange creates the increase in liquidity so that you can sell those options. Now, people always say, well, who's on the other side? It doesn't matter. The exchange is on the other side. The clearinghouse is on the other side to make sure that there's someone there. They will be the ones that are taking the responsibility. All you have to do is show up at the exchange, and in your case, you're going to do that through your broker, and you just send the order in and you say, I need to get out of this trade. I got to close this trade out, sell this thing. And your broker will help make sure that the whole thing is facilitated. That's what the exchange is for. Make sense? Okay, so now that I hope that all of you understand that a little bit better, let's get into call options. Call options work as the insurance policy for the short trader, but as we saw tonight already, as the stock value increases, the call option value increases. So as a speculator, now we're making another step forward. We started with a call option for the short trader as an insurance policy, but now we're going to the same position. We're going to buy a call, which technically is an insurance policy for a short trade. That's technically what a call option is. But you don't care about that. You don't care about shorting the stock ever. As a speculator, you're going to solely purchase this call option for the purpose of profiting as the option value increases. That's it. And how's the option value going to increase if you purchased a call? It's going to increase if the stock value increases. Consequently, buying calls is a bullish trade. Now, understand what I just said. Buying calls is a bullish trade, period. You're buying calls because you believe the stock is going up. Yes, a call option in and of itself is an insurance policy for a short trader, but you don't care about shorting the stock. All you care about is having control of the stock if you need it and taking that little control instrument that we call an option contract and making a profit on it. Ka-ching. That's it. So let's come back to our Texas Instrument trade. You could have shorted the stock at $29.19. And you said, well, I bought this call option because I want to offset my risk. I get that. You wanted to offset your risk. But let's forget the short trading position altogether. Forget that you were ever bearish. Consider that maybe you were bullish. If the stock did run up, what would happen to that call? The call would increase as the stock moves higher. So instead of ever getting into buying the stock, you could have simply purchased the call with that strike price of $30 per share. Now, here's the benefits for you as a stock speculator, or in this case, an option speculator, because we're making the jump now from stocks over to options. You have a lower cost of entry than if you just purchased the stock. If you purchased the stock, it would have been $30 a share. But by buying the option, you're buying it for an option premium, Valerie. You're going to pay a small amount of money for the premium, but you're going to get the full control. It gives you a lot of leverage. You have very limited risk with a theoretically unlimited reward. Wow, that's pretty awesome. Let's take a look. Let's take a look at the power shares of the QQQ. Notice the triangle that has formed here. This is an ascending triangle. And as we're running up into resistance, boom, 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 we finally have the breakout. Based on everything you've learned about stock formations and price patterns, does this look like a bullish trade? Yes or yes? Now, what are your options? Let me use a better terminology. What are your choices? You could buy the stock. So let's buy 1,000 shares of the QQQ at $65.50 a share, because that's about where we were at this price point. $65.50. That's going to cost you $65,000. Now, I don't have any problem with you investing $65,000. I just realized that most of you don't have an extra $65,000 sitting in your back pocket to put onto the Qs for a short-term 2 or 3 or 4 week trade. And if you did have it, you probably don't want to do it. So let's look at an alternate trade. The alternate trade would say, instead of buying the stock, I could buy 10 option contracts. Now, where did 10 come from? That's because option contracts trade with how many shares? 100 shares in a contract. So you could buy 10 option contracts, which gives you 1,000 shares of the QQQ with a $65 strike price. And yes, I did some research, and that's only going to cost about $1.31 premium. Valerie, the premium is the amount of money you pay for the option. The premium, Valerie, gives you the right to buy this stock at $65 a share. It only costs you $1,300. Wow, that is leverage. You have control of $65,000 worth of stock, actually $65,500 now that I'm looking at the 50 cents. Forgive me. It's the first time we've taught these. I know that you're going to be forgiving for these little errors. $65,000 worth of stock, and you have control for only $1,310. Wow. That is leverage, isn't it? $1,310. Now let's see what happens as this trade moves forward. Because as the trade moves forward, we could, as we trade all the way to $70 a share, we could say, okay, I now have between $70 and $65 in value. I could buy the stock for $65 a share and turn around and sell it at 70 and realize $5 per share profit. That would be called exercising. That would be called exercising your option. If you buy the stock and then you turn around and sell it, that's called exercising your option. You're going to exercise your right to buy the stock at 65 and turn around and sell it at 70. This is a lot of work. You don't need to do that. Why exercise the trade when you can turn around and sell the option? Now let's look at the difference here. If you did the stock trade, you would have put $65,500 into the trade, sold it for $70,060. If you did the stock trade. If you did just the option trade, you would have bought the options for $13.10 and you sell the options for $5.06 per share. How did I come up with that? Well, the difference in $70.06 and our strike price at $65 was $5.06. This strike price of $65 has got to be worth at least $5.06. Can you guys see how that works? It's got to be worth at least $5.06. Why? Because the stock is presently worth $70.06 and you have the right to buy it at $65. That contract in and of itself has value. It's something we call intrinsic value. It's built in. It's built into this contract at this point because the stock has increased all the way up to $70.06. So it's got to be worth at least $5.06. Now you have the two choices. You could exercise the option, selling buying the stock for $65 a share and turning around and selling it for $70.06, or you could just skip that whole step and just sell the contract. Sell the contract that has a value. How much can we sell it for? $5.06 a share. Who's going to buy it? It doesn't matter. The exchange will take care of who's buying it. That's pretty cool. So we're just going to sell the contract. Let's look at how this works out. If we did the option trade, we would have had about a $5,060 profit, and my numbers are off because I should have had $65,500 in there. Please forgive me. Anyway, that would have given you about a 7% return on your investment. With the option trade, you would have had a $3,750 profit with a 286% return on your investment. And by the way, that whole thing took about 2 months. Not too bad. How many of you see and understand the value of just trading the option move? You're not worried about, I mean, you are worried about the stock, but you're not worried about taking possession of the stock. You just need the stock price to move. You just need the stock's price to move, okay? Now, any questions about call options before I move on to the next phase talking about put options here? Okay. Sorties says, I see the light. Hallelujah. Well, look at that. We got a worshiper out of Sorties after all. Sorties, I'm proud of you. You're coming all around. All right. DG is confused. Well, DG, can you be more specific on your confusion? Most of you are saying you got it here. I'm just looking for some confusion that I can clarify. Okay, DG, I'm going to let my moderators work with you because I'm not seeing your feedback yet. So moderators will pick up with you. The rest of you, I think, are on board. So let's move on and talk about put options. Puts, here we come. The put option, remember, works as an insurance policy for the long trader. Remember this? The put option is an insurance policy for the long trader. As the stock's value decreases, the put option's value will increase. Consequently, if you're a long stock trader, you would buy a put as insurance. But let's say you're not a long stock trader. Rather, maybe you look at a trade and you say, hey, that stock looks like it's going down. I think I'm just going to buy the option and ride it all the way down. As a speculator, all you care about is the profit on the option as the option increases. So as a speculator, you're going to purchase a put option for the sole purpose of profiting on the option as the put increases in value. How does a put option increase in value? A put option becomes worth more when the stock goes down. That makes buying puts as a speculative trade a bearish trade. Straight up. All right, let's move over here and take a look at this example for Sears. Whenever you bought the stock at $62.91, it made sense to say, hey, this thing looks like it was going bullish, so you purchased the stock. As protection, you decided to buy the puts. In the event that the trade went down, your put value would increase. That's how you look at it as a hedger if you're a long stock trader. Okay? But as an option speculator or an options trader, you're thinking, not from this setup, but you're thinking that stock's going down. I want to ride the increase in the put option. Consequently, that's the speculative move that you're looking at doing. Now, here's the benefits of doing that. Number one, you've got a lower cost of entry than simply selling the stock short. Selling the stock short takes a margin. Even though you technically receive money, you've also got to put up at least 50%, giving you 150% total margin. That's one of the benefits of buying a put. As a put buyer, you are not required to match the short trader's margin requirements. As a put buyer, you are in a highly leveraged trade that has a limited risk with a theoretically unlimited reward. That's pretty cool. So let's take a look here at how this could work out. You're trading along with Baidu here. You see the trade setting up. It's starting to top up here. Maybe you're even thinking, hey, that looks kind of like a double top. I've got some necklines down here. If this thing breaks, I'm breaking a trend line and a neckline. This thing could really be an explosive bearish move. You're setting up for the trade. Sure enough, the trade gaps out, giving you a... Look at me. I'm trying to draw on my screen and I'm moving my slides forward. The trade breaks out, giving you a breakaway gap. By this point, you're thinking, this trade is going down. I need a bearish trade. What do? You could short Baidu at $143 a share. You could short it, bringing in $143,000. Because remember, you're selling it. If you sell short, You're selling the stock. So if we did 1,000 shares, you'd be bringing in $143,000. Or instead of shorting, you could buy 10 contracts of Baidu 145 puts. That cost is going to be about $11.25 a share, costing you about $11,000 to get into this trade. So you could bring money in, $143,000 straight up, or you could spend money. What do you want to do? You want to bring money in, right? Well, don't forget, you've got your margin. So you're going to have to put money up as well, which is going to be an additional 50%. It's going to be 100% of the money you brought in plus the additional 50% margin for your short trade. Okay, now let's watch and see what happens here. Boom. Baidu sold off very rapidly. As the stock started to bottom down here, you started to see it slowing down. You look back and you said, hey, there's a support level. I'm going to buy at 115. In fact, it turns out you purchased at 115.68. You buy to cover, spending $115,680. That money goes out to cover your short positions. You were short, and now you bought to cover down here at 15.68. That was one trade. The option trade would have been simply to sell the put. Well, how much is the put going to be worth? Well, you think about it. We had the right to sell at 145. That was your put. We have the right to sell at 145. The stock has dropped to 115.68. That is a difference of $29.32. $29.32. This option contract must be worth at least $29.32. You sell all 10 contracts, which is the 1,000 shares, bring in $29,320 a share. Not too bad. Look at your profits on this one. Because of the margin, with the short trade, you ended up with about a 38% profit. With the option trade, you ended up with 160% return on your trade. By the way, with the short trade, how much risk did you have? Unlimited risk versus limited risk with your option trade. Unlimited risk, it took more capital. It would take about $71,000 minimum for your capital on the short trade versus $11,000 capital on buying the put, and your ROI was exponentially higher. How many of you think that you understand why we would buy puts as a speculative bearish trade? And how many of you understand what we're doing? When we buy a put, we are simply speculating on the value of that insurance premium for that particular put. Now, let's kind of wrap some of this stuff up here, and then we'll take some questions here in just a moment. When you buy a call, you're long. I've already mentioned this, but I'll mention it again. When you buy a call, you're long that call option. You want the call to go up. You're going to sell the call to close the trade. You buy to open, you sell to close. It's that simple. When you buy a call, you're long the call. You want the call to go up. You sell the call to close. You buy to open, sell to close. That's it. When you buy a put, you are long the put. You want the put to go up. How's the put going to go up? The put's only going to go up if the stock goes down. So you want the put to go up, you're long the put, you sell the put to close the trade, you buy to open, you sell to close. It's the same trade basically, it's just that the call is more bullish in nature and the put is more bearish in nature. Option traders want to sell before the expiration. If you don't sell before expiration, you're going to lose money. Well, I say that you're going to lose money. It depends on how much value you have. You may not lose money, but you could lose money if you don't sell before expiration. If you don't sell before expiration, you're taking delivery of the stock. And by taking delivery, I mean it's going to be exercised even if you turn around and you sell it. Okay? So that brings the question, well, which option do I buy? Oh, I'm so glad you asked this question. Which option do I buy, Jeremy? Well, the ultimate goal of you as an option buyer is to have an increase in the option price. Why? Because remember, when you buy an option, you're long that option. When you're long anything, you want the option, or you want that price of that thing to increase. So if you're long the option, you want the option to increase in price. Simply buying the option, however, will not guarantee a profit. In order to get a profit, you must buy an option that builds or accumulates real intrinsic value. What is real intrinsic value? That is the value difference between the price of the stock and the strike price of the option. The value difference between the price of the stock and the strike price of the option. Now, technically, you can buy any option you want. Okay, I'm going to give you some rules here, but technically, you can buy anything you want. But what you've got to realize is, according to CBOE, about 76% of options expire worthless. Well, if your goal is to have an increase, you don't want it expiring worthless, so you got to have a little strategy here. So what I want you to do is I want you to buy an option that stands a legitimate chance of having intrinsic value. If you start out with some intrinsic value, it's going to be better. So how do we know where intrinsic value starts? Well, again, the intrinsic value is the difference in the stock price, which at this particular stock is $146.65. The difference in the stock price and the strike price. So if you've got a call option, which is the right to buy the stock, and you have the right to buy at 147, do you have intrinsic value? Well, no, 147 is higher than the stock price. That's not intrinsic at all. So how do you find intrinsic value? Well, you got to go to a lower price. Would 142, would that have intrinsic value? Well, yeah. I mean, if you had to close this trade today, the stock is worth 146.65. The strike price would be 142. So the difference there would be $4.65. Okay, so we've got $4.65 real value. Excellent. We call that intrinsic value. Any option that has a strike price that is better than the stock price has intrinsic value. Any option that has a strike price that is better than the stock price has intrinsic value. So how do we know how to set ourselves up for a winning trade? Well, understand that the option price will increase the most when it has intrinsic value. The option price is going to increase the most rapidly when we have intrinsic value. So it leads reasonably, logically, to say that the safest option is an option that already has intrinsic value. Are you seeing how this works? Already has intrinsic value. If you buy a stock that, or you buy an option that already has intrinsic value, then the odds are higher that it's going to end with intrinsic value. Okay, so if the option starts out with intrinsic value, it should end with intrinsic value. Assume the trade moves in your direction. Well, let's take a look over here at this strike price. The stock is trading at 146.65. Anything below 146.65 has intrinsic value. Anything below 146.65, it has built-in value. So 146, 145, 144, 43, and 140. All of these strike prices have intrinsic value built in. Every one of them. Starting with 147, we do not. Anything above 147 does not have intrinsic value. Consequently, look at the price of the options. They get cheaper and cheaper. Stocks, or I should say options with no intrinsic value, have a higher probability of expiring worthless. That would cost you all your money. Compare that with stocks that have or options that have intrinsic value. Options that have intrinsic value have a lower possibility of expiring with completely worthlessness. Okay, and in order for an option to expire worthless, it has to have moved to where it's no longer got any intrinsic value. So basically, on this option chain, any of the 146, 45, 44, anything below 147 has intrinsic value. Does that make sense to you guys? Okay. Now, what do we call the rest of these? I'm going to talk more about this in the next class, but we call intrinsic value intrinsic is in the money. If there's no intrinsic value, we call it out of the money. And in the case of 147, we call that one at the money. In the money, out of the money, and at the money. Okay, now let's move over to the put side of this. What's the difference in the put and the call in terms of intrinsic value? I have shaded this option chain with the intrinsic value. Notice that in this particular chain, the at the money was at 114. So anything that is lower, which actually looks higher, but it's really lower, 113.50, 113, 120, 112, etc. These all have intrinsic value. Those are calls. Puts are the exact opposite. For calls, the lower the strike price, the more intrinsic value. Remember, a call is the right to buy. So you always want your strike price to be lower. The lower the strike price, the more value the call is. The put is the option, or is the opposite. The put is going to be the higher strike prices. Since the put is the right to sell the stock, you always want the strike price to be higher. You're always wishing it was higher. Okay? So the higher the strike price in the case of the put, the more built-in or intrinsic value. Consequently, if you come over here and you look at this option chain, you see that I've shaded these darker, or these bottom ones here, as in the money. Okay, so at the money, again, is the one that's right in the middle. Okay, with the calls, in the money will be cheaper strike prices, 113.50, 113, 112.50, 112, 111.50. These will be in the money. These have intrinsic value. At the money is basically right where the stock is trading, and these are out of the money. Okay? Now, if you come over here to the put side again is the right to sell. So would you rather sell at 114 at the money, or would you rather sell at 116.50? You'd obviously rather sell at 116.50. That's got value to it. Who wouldn't want to sell for $2.50 higher? So that's going to have $2.50 more value than the 114. Therefore, these options that are higher in strike price will have more intrinsic value. Consequently, they are in the money. At the money is where the stock is currently trading, and the lower strike prices for the puts will be out of the money. Adam says, why are in the money strike prices safer? Adam, the reason in the money strike prices are safer is because they have more intrinsic value. Safer is not really the right word, actually. Is that there's more substance to it. If we get to expiration, let's say the stock is trading. Let's say you have a call. You have the right to buy at $115 a share. And let's say that expiration were tomorrow. And the stock is currently at 114. Adam, would you rather buy at 114 or would you rather buy at 115? You would rather buy at 115. Okay, understanding that you would rather buy at 115, I just lied. You'd rather buy at 114. Understanding you'd rather buy at 114, who is going to want to buy at 115? And the answer is nobody. So what's going to happen to that 115 option? It's going to go down in price. Nobody's going to want to pay $1 to have the right to buy at 115. That's crazy. That's an out-of-the-money option. Now, what if you had the right to buy at 112 and the stock is going to, the option is going to expire tomorrow, current stock price is 114. Adam, would you rather buy at 114 or 112? And of course, the answer is you would rather buy at 112. Therefore, there's real value in the ability to buy at 112. We call that premium value. And you can look down the list here and you can see that the 112 strike price is worth more. In this case, it's 355. It's 355 because of premium, which we're going to talk about in the next class. Make sense? Now, James says, this is where I get derailed. He says, why would anybody want to buy a contract with the right to buy at 145 when they could buy at 115? Well, nobody's going to want to buy the contract for the right to buy at 145. You mean James, clarify a moment. James, I think I'm not understanding your scenario. If you're a speculator, 145 is so far out of the money that you would never do it. Is that what you're saying? Nobody would do it at 140. Nobody would buy at 145 when the stock is at 115 because it's just, they're probably not going to trade it. It's like a penny. It wouldn't be of any value. Oh, that was my example I put earlier. Well, because okay, James, the scenario is that right now, the stock is trading at 114. So, James, right now, today, you buy the call at 114. Right now, you bought it at 114. Then, over time, the stock increases to 145. You're not buying the stock at 145 now. You have the right to buy it at 114. Does that make sense? So you're missing the time component, I think. Let me move to one more slide, and then I'll try to answer all your questions at the end. Here's your next to last slide. Here's your basic rules. You're buying calls for bullish trades, buying puts for bearish trades. Now, this is not everything, obviously, because the next class, I've got to get into pricing, and I'm going to add rules to this strategy. So please do not do anything other than virtual trading with this strategy unless you already know it. Don't do anything with it until I teach you some more rules and you understand some more stuff after the next class. We'll talk more about intrinsic value in the next class as well. All right, here's your action steps. Find some potential bullish trades. I want you to buy 100 shares of stock in your virtual account. Then I want you to turn around and on the same stock, I want you to buy 5 contracts of the call options. I'll specify call for the same stock. Okay, so find a bullish trade, buy 100 shares of stock in your virtual account, buy 5 contracts of a call option on the same stock. Watch how the stock moves and watch how the option moves relative to each other. Okay, and what I'm going to suggest is with your call option, pick a strike price that has at least some intrinsic value. It can be at the money, it can be 1 in the money or 2 in the money. You don't have to have a lot of intrinsic value. Just pick a little bit, and then as the trade moves in your direction, you'll get a lot more. Then I want you to do the exact same thing with a bearish trade. So go short a trade, find a bearish trade set up, short it. Virtual account, again, virtual. Okay, short the trade, then do the same thing by shorting 5 contracts of puts. Or not shorting 5 contracts, excuse me, buy 5 contracts of put trades for the same stock that you just shorted. All right, so do the exact same thing for a bearish trade. James, did I clarify your question? Did I get you clarified, or are you still confused here? Puri says, any suggestions for stocks to buy for this exercise? Puri, my friend, you are not only a retake student, you have been through all of this stuff over the last couple of months together. You have the ability. You go over to your charting software, you follow the rules that we've laid out. I've given you plenty of rules and plenty of opportunity. I want you to pull the stuff together. You can do this. I promise. And if you have any other doubt, go back to class, was it 5? Where we talked about the moving average system? Just use the moving average system, if nothing else. Okay. Bill says whenever you buy a call, the ask price, you're already behind the value of the option as opposed to just buying the stock. So you have money to make up when you sell at the bid price. For instance, buy an option at 513 and sell at 506. It's an instant loss. But if I buy the stock at, say, 142, you could still sell at 142 anyway around that. Bill, you're missing the point. You guys are still worried about the stock price. Get over the stock price. You're still trying to worry about, could this be a better deal if you trade the stock? It's not a better deal to trade the stock because you're not trading stock. You're trading the option. Okay, we're not worried about taking possession of the stock, and we're not worried about the price movement of the stock. We're worried about the derivative movement that happens in the call option. So as the stock moves further up or down, the call option will get more intrinsic value. And yes, theoretically, you have something to offset, but immediately, as soon as the stock moves up, the call will move up in value. Does that make sense, Bill? So you're looking at the wrong thing. James, you're still confused. James, I tell you what I want to do. Because I think you've been confused on this issue for a long time. I want you to connect right now. I want you to send an email to Jeremy Newsom. Well, just send it to success@tradesmartu.com. Schedule a phone call. Schedule a phone call with Jeremy Newsom or Stacy, whichever one can schedule you the fastest. Get this question answered. You are 2 inches from gold. Literally, you are so close. Okay? Okay, if you own and you sell a covered call and the stock price goes up, can you buy a call to recover your loss? Yes, George, you could. Dave, I did pay for the put contracts in my example of $29,000. You sold for $29,000, but I took that out. Okay, so that's got clarified by the moderators there. Okay. Frank, I'm not sure what that means. You have to rephrase it. I'm trying to catch up with all y'all's questions, and some of these are comments with the moderators. Oh, look, I've got a red flag. That one's specifically for me. There comes a point when you need to sell those options. It has to have some value to someone or no one will want to buy it. I don't see how. Gotcha, James. In the example, he says, I don't see how, in the example you made earlier, why someone would buy that particular option. James, it doesn't matter why they would do it. The exchange makes it happen. The exchange makes it happen. You don't have to sit here and say who would do it. It doesn't matter who would do it. The exchange makes it happen, and realize that the exchange's job, they're a market maker. They're a clearinghouse. They'll make money on a spread. They'll make some money somewhere in the deal. Because you see, you're still going to be selling at the spread price or at the bid price. Okay? And so they're going to make money somewhere in the deal. It doesn't matter to you how they manage it. What matters to you is that you got out of the trade. And of course, the worst case scenario, James, is that you would do a simultaneous exercise and liquidation. So the worst case scenario, James, in the case of the 145 put, you purchased a put at I forgot the example. You purchased a put at 145 and the stock tanked. So in the case of the 145 put, the worst case scenario, James, is that you would call your broker and you'd say, hey, I got a 145 put. I want to sell it. Nobody's going to buy it. What can I do? And they say, okay, let's exercise it. And you can simultaneously exercise and offload the stock position so you still make your intrinsic value, James. So you're worried if there's going to be liquidity. And what I'm saying is between your broker and the exchange, you will get the deal. You've got the rights to the sell. Worst case scenario is you exercise it. But since you can do the simultaneous close with it, you can just do that. Make sense? Oh, wonderful. Okay, for those of you that are asking questions on pricing and how we're getting premiums and whatnot, please hang with me. I just got more classes to teach. Okay, so I realize that you're swimming a little bit tonight. I think that I'm hoping that this has laid a really good foundation for the next two classes for you. And I'm hoping that you understand the nature of options trading a little bit better. My intention in this discussion tonight was to show you why somebody would just trade the underlying, or would just trade the stock. Let me say this correctly. Why someone would just trade the option and not the underlying stock. And you would just trade the option because of the option premium going up and down. Okay, that's the issue that I really want you to understand. What I really want you to understand is that in and of itself, the option is a derivative of the stock. It is basically an insurance policy. But as the stock's going up and down, that option is going up and down in price as well. As that option is going up and down in price, you have the opportunity to make a profit on it. And that's what an option trader does. Make sense? Okay. Thank you for those of you who say it was a great class. Elias says, is sell to close a put option? Is it buying an option? No. If you sell, Elia, you're not buying. Just think through the question. Selling is not buying. If you sell to close, you do exactly that. You sell to close. Okay. Honestly, guys, the easiest thing you can do, go to your virtual account, buy to open, sell to close, watch what happens. It's amazing how much clarification comes in when you just start putting it into practice and start doing some stuff. Even if you're confused, that's okay. That's why we have virtual accounts. Okay. Okay. Okay, I think that's all answered there. Yes, Kurt. As an options trader, you're trading the option like stock. Jeannie says, I'm done. Jeremy is done. Thank you, TradeSmart. I think she means she's going to bed. I think that's what Jeannie meant. Julius says, answer my question. Can someone answer my question? Julius, I would love to answer your question. I'm not sure where your question was, but I know that my moderators are working overtime to find it. Oh, here we go. Julius says, when do we sell the option? Is it on the ROI we want or the price of the stock? Good question, Julius. His question, if you didn't understand it, is when do I sell the option? Is it based on the stock price or based on my return on investment? And Julius, the answer is based on the stock price. That's why I spent so much time in the last several classes together teaching you how to read the stock price. Because if you don't know where the stock should be trading to, you don't know where the options should stop moving. So you can only trade an option effectively if you know what the stock is doing. Even though you're not really that worried about the stock's price, it's a direct derivative, so you have to understand the stock price. Okay. Okay, wonderful. Okay, thank you. Appreciate it. Got some confusion getting clarified here. DG is still confused, wants to know who's going to clear up his confusion. Not sure what the confusion was. DG, fire it in there again. I'll answer it. That'll be one of my last questions that I'll take here as we turn in the evening. Did I mean it in a bad way? Oh, didn't mean it. Oh, okay, gotcha. Oh, I said Jeannie, but it's Jenny, not Jeannie. Forgive me, Jenny. And I hope next time I'll read that correctly there. So Sorty says, Jeremy, many times this chart analysis says one thing, but the stock is doing another thing. Sorties, I happen to know because Jeremy Newsom told me you have a success coaching session with him coming up on Thursday. I think he's going to help you. I think he's going to be able to clarify some stuff for you. Is that correct? You've got a session coming up with him very soon? I think what's happening is you're reading into some stuff, or just you're overthinking it probably. All right. Thank you. I appreciate that, Edmund. DG, I never got your question. DG, what was your confusion? I want to help you if possible. But if you don't get it in here fast, it will not be answered. And by fast, I mean you have like 1 minute. Kurt says, Jeremy Newsom, what a guy. Jeremy, he's talking to me, you scored big with that kid, talking about Jeremy Newsom. I think we did pretty good with Newsom. I'm pretty proud with him. I just got to try to teach him to change his first name, or, at least learn to spell it. Poor, I can't imagine how confused he was in kindergarten when his teacher kept trying to tell him, no, you've only got one R. And he kept saying, no, my mommy said I have two. Can you imagine how confused he was? Poor guy. Just got to be confusing. All right, ladies and gentlemen, I am going to talk to you in the next class. We're going to call it a night here. DG never wrote in, so I don't know what his question was. I got lost there. But anyway, next class, I'm hoping that I will clarify a lot of stuff for you. I'm hoping I will. Hey, some of you guys have been through this program before. You're doing a retake right now, and some of you are actually quite advanced. You know who you are, and it might be the right time for you to start taking Fibonacci trading with Josh. You don't have to do that. It's not essential to become a good trader. I just want to let you know, as you're probably aware, that he's starting a class tomorrow night on Tuesday and Thursday. And this is the last time this year you'll be able to take it. It's the last time probably for about 6 months, because we can't find a time to schedule another one before March of next year. So it's going to be the last time that Fibs will be taught live for a long time. And so this is a really good time to jump in there. Tuesday and Thursday does not conflict with the Monday, Wednesday class. So if you guys are interested in doing so, either sign up on the website or give success at tradesmartu.com an email, and they'll hook up with you. All right. Yes, great point. Kurt says, go to the social network, ask questions. Students will often help you on social networks. That's a great point. Thank you, Kurt. Yeah, students, please go to the tradesmartu.com website, log in, get on there, ask questions. There's a forum, and there's a group for this class for Foundation Stocks and Options Level 3, where you can ask your questions, and a lot of your fellow students will already be able to help you because they already understand, and sometimes they explain it better than me. And hey, if that's the case, then great. That's why they're here helping you. All right. So you guys have an awesome night. I'm going to call it a night. I'm going to leave this open for a little bit while the moderators wrap up a few of these lingering questions, because we do have quite a few kind of dangling questions out there. And good night. Happy trading. I'll see you Wednesday.